think all investors are familiar with the notion that an investor will buy a share today with the hope the share price will appreciate in the future, allowing the investor to sell the share at a higher price and pocket the profit. Now, short selling is the exact inverse to that scenario. That is, an investor sells a share today with the hope that the share price will depreciate tomorrow, allowing the investor to buy those shares back and profit from that share price decline. Now, obviously, the mechanics behind these sorts of transactions are a lot more complex than that. There is the issue of locating a lender and finding the borrower, selling their shares, and then ultimately buying those shares back to deliver to the original lender to complete the transaction. There's also rules and regulations that govern these sorts of transactions. However, the underlying principle is no more or less complex than that. Now, if you think about it, the ability for absolute return managers to profit from falling asset prices is a very important element of an absolute return fund manager's strategy. By using short selling, the asset manager is able to effectively hedge against falling markets. It's a way of reducing risk. Any profits during a falling market that are made from short selling is effectively used to hedge against falling values in the long positions. It's a way of dampening down volatility, reducing risk, and potentially enhancing returns. Now, there is a very strong distinction between absolute return managers who are able to short sell and traditional long-only investment managers who aren't. Traditional long-only investment managers are often locked into being fully invested or close to fully invested at all times by their investment management agreements, affording them limited flexibility to protect their capital in falling markets. A very interesting year was 2008, where Bennelong Kardinia Absolute Return Fund was able to short sell and to use effective use of short selling to generate a small but positive return. This was a year where equity markets fell over 40%.